Renewable investment growth slows in 2024. Global investment in the energy transition climbed to an unprecedented USD $2.4 trillion in 2024, with $807 billion directed toward renewable energy technologies, according to the latest Global Landscape of Energy Transition Finance 2025 report from the International Renewable Energy Agency, IRENA, and the Climate Policy Initiative. The figures confirm strong momentum across clean energy markets, but they also reveal a meaningful loss of speed at a critical moment for global climate goals. Although the total volume of renewable investment reached an all-time high, annual growth slowed sharply, rising just 7.3% in 2024 after expanding 32% the previous year. This deceleration raises concerns about whether global deployment can align with commitments made at COP28 to triple renewable capacity by 2030. Key findings and their system-level implications. Investment remains heavily concentrated. Roughly 90% of energy transition finance continues to flow to advanced economies in China, leaving emerging and lower-income regions with limited access to capital. This mismatch reinforces structural inequities in both energy access and climate vulnerability. Financing structures lean heavily on debt. Nearly half of investments in 2023 were financed through market-rate debt, while grant-based support accounted for less than 1%. In regions where borrowing costs are already high, this dependence on commercial debt could restrict new project pipelines. Manufacturing is geographically imbalanced. Between 2018 and 2024, China represented about 80% of global manufacturing investment in solar, wind, battery, and hydrogen technologies. This degree of concentration heightens exposure to supply chain disruptions and geopolitical risk. Technology deployment is uneven. Battery manufacturing investment nearly doubled to $74 billion in 2024. Yet overall manufacturing investment declined 21% to $102 billion. Meanwhile, solar PV saw record investment of $554 billion, up 49%, but 96% of all renewable investment remains focused on power generation rather than harder-to-decarbonize sectors such as industry, heat, and transport. Why slowdown is significant progress is insufficient relative to climate timelines. Record investment is not the same as adequate investment. To remain aligned with a 1.5 degrees pathway, deployment must increase significantly beyond current rates, especially across grids, storage, and non-power sectors. Emerging markets face widening gaps. Markets with the most potential for new renewable capacity continue to face the highest cost of capital. Without targeted interventions, investment disparities could lock in long-term inequalities in energy access and climate resilience. High debt exposure raises financial risk. Market rate financing exposes developers to interest rate volatility and exchange rate pressure, particularly in regions already navigating economic instability. Without concessional finance or blended finance tools, project viability will remain strained. A concentrated manufacturing base threatens resilience. Supply chains dominated by a single geography elevate the risk of price shocks, trade frictions, and delays, all of which can slow down the pace of deployment. End-use decarbonization is lagging. Investment continues to prioritize electricity generation, leaving industrial heat, heavy transport, hydrogen, carbon management, and building decarbonization underfunded. Without more balanced progress, early wins in power generation will not translate into economy-wide emissions reductions. What needs to change? Increase capital flows to emerging markets through grants, concessional loans, blended finance structures, and public sector risk mitigation mechanisms. Deploy more innovative financing tools, including guarantees and insurance products, to unlock private sector capital in underserved regions. Strengthen regional manufacturing capacity across multiple geographies to reduce supply chain bottlenecks and increase resilience. Accelerate funding for end-use technologies in buildings, industrial sectors, and transport to advance beyond power sector decarbonization. Ensure investments translate into real deployment through grid modernization, permitting reform, and scaling of storage solutions. The 2024 investment landscape shows a sector gaining strength but losing momentum. Record capital flows demonstrate commitment, yet the slowdown combined with concentrated financing patterns and supply chain dependence, indicates that the global transition is still far from the pace required to meet 2030 and 2050 climate targets. You've been listening to Sustainability Soundbites presented by E plus E Leader. For partnership opportunities, reach out to a member of our team.